Shanna, when most people think about borrowing money, whether it's to buy a car, purchase a home, or even go to school, they tend to look at the process through a single lens: the monthly bill. They look at their current budget and ask, does this amount fit into my monthly budget right now?
100%, Daniel. And that's just truly a great starting point. You always want to make sure a payment fits comfortably within your means. But what we often overlook is the connection between our debt and our time. So when you borrow money, you are using a tool that allows you to enjoy something today using your future earnings.
Exactly. It's an exchange of time. You get to drive the car or live in the house right now, and in return, a portion of your future working hours will go toward paying back what you owe, plus the cost of borrowing, which is interest. Interest isn't a penalty, it's simply the cost of moving your timeline forward so you don't have to wait 20 years to buy a home.
That's right. And it's a healthy way to frame it. So borrowing is a partnership that provides immediate opportunity. But to be a great partner in that system, you want to manage your timeline efficiently. If you understand how loans are set up, you can actually use simple strategies to pay off your balance early and then buy back your future freedom.
I absolutely love that perspective.
I know.
And today, we're going to look at debt through the lens of time. We're going to look at how loans are set up, how interest works over the life of a loan, and how adding just a few extra dollars to your payment can shorten the timeline, save you money, and hand you total control over your long-term wealth. Welcome back to this episode of Making Sense of Your Sense. I'm Daniel Hill.
And I'm Shanna Browning. So today, we're opening a massive topic up: the visualized cost of debt. We're going to explore the value of time in financial planning, how standard loans are set up, and really, Daniel, what you just said about how making extra principal payments can speed up your journey to being really completely debt-free. If you're currently paying down a loan, this episode hopefully will give you a clear, positive roadmap to cross that finish line early.
Exactly. And Shanna, let's dig into the idea first that borrowing is essentially an exchange of time. When someone takes out a loan, the financial institution is providing the money up front so the consumer can achieve a life goal immediately. But how should a borrower visualize the long-term cost of that convenience?
Well, I think one way to look at it is to help tie the numbers directly back to your working hours, Daniel. So let's say you take home $20 an hour after taxes. If your total monthly payments across your loans add up to $400, well, that means 20 hours of your work that month are dedicated to fulfilling those past agreements.
Wow, that makes it incredibly real.
Oh,
That's
yeah.
half of a standard work week. Now, looking at it that way isn't meant to make you feel bad about borrowing. After all, without that loan, you might not have the reliable car that gets you to the very job every day.
That's right.
It's a trade-off that provides real value.
I mean, that's exactly how to look at it. And so it's a tool for progress. The interest rate is simply the price for getting to use that tool today instead of 10 years from now on. But as a consumer, your goal should be to minimize the time you spend paying down that debt so you can redirect those working hours into your own savings,
Mm,
investments, vacation time, personal goals.
right. And because the shorter the timeline, the less total interest you pay over the life of the agreement. When you see an interest rate on paper like 6 or 8%, it can feel like a static background number. But when you
Yep.
visualize it as a timeline of your own labor, you start to realize how much power you actually have to optimize that plan.
Spot on, Daniel. Spot on. It completely shifts your mindset from a passive view of, well, this is just my bill for the next 5 years, to more of an active view of how
Hmm.
can I efficiently manage this timeline? And when you understand that every payment choice you make impacts your future calendar, you become a much more strategic manager of your money.
Now, let's talk a little bit about how loans are actually set up, because I feel like this is where a lot of people can get confused. In the financial world, we use a structured payoff table to map out a loan from day one until it's fully paid off. Shannon, how do those tables or those schedules distribute your payment over time?
Let's talk about that for a second. So, a standard loan schedule is designed to ensure the loan is completely paid off by the end of that timeline. So, to do that safely, the math splits your monthly payment between two things: paying down the actual balance you borrowed, which is the principal, and then covering the interest that built up over those past 30 days.
And because that interest is calculated based on how much money you currently owe, the interest portion is naturally higher at the beginning of the loan when the balance is at its highest.
That's exactly right, Daniel, and it's just pure math. So let's just use a classic example real quick. So like a 30-year home loan for $200,000 at a 6% interest rate. Your standard monthly payment for that core loan and interest would be about $1,200. But on that very first payment, because you owe that full 200,000,
Hmm.
the interest portion accounts for about $1,000 of that check.
Wow.
I know. But while the remaining $200 goes toward dropping the actual balance you borrowed of that 200,000.
And as the months go on, that $200,000 balance slowly shrinks,
That's right.
and interest charge shrinks along with it. That means more and more of your $1,200 payment naturally shifts toward paying down that raw balance.
That's right. And it's a gradual shifting scale. But because the core balance drops slowly in the first few years, the timeline can really feel very long if you stick to that basic path. So if you sell your house or you look at the balance after 5 years, you might surprise yourself by seeing how much of the original balance is still left, simply because the early years are naturally weighted toward processing the interest of that large borrowing balance.
And that's exactly why banks provide these transparent schedules to consumers, to the borrowers, from day one. It's not meant to be a secret system. It's an open map. And once you look at that map and see how the numbers shift, you quickly realize that you don't have to just sit back and let the standard timeline dictate your financial future. You can actually take steps to speed up the process. Hey everyone, Daniel here, stepping in for just a quick second. When we started making sense of your sense, we had one simple goal: to take the confusion out of everyday finances. We believe that financial education shouldn't be locked behind fancy jargon or expensive consultants. It should be practical, accessible, and easy to understand for everyone. If you've learned something valuable from our show, maybe a tip that saved you a few bucks or a concept that, just finally clicked, do us a huge favor and share that episode with a friend or family member. True wealth is built when we all learn and grow together. Thanks for being a part of this community. Now, let's get back to the show. So, let's talk a little bit about the solution. How does a borrower step in and actively shorten that map? How do we accelerate our progress on a payoff schedule?
So, really, your best strategy is the extra payment on the baseline balance. And that's what we call the principal balance. When you send even a small amount of extra cash above your required monthly amount and specify, and there's the key word, you have to specify that it needs to go directly toward the balance you borrowed, the principal, that money does something really extraordinary. It completely skips the interest calculation for that month.
Wow. And we call that a principal payment. And
Correct.
that's the key distinction right here. 100% of that extra cash immediately lowers the raw amount that you owe. It doesn't get split. It doesn't go half to interest and half to principal. It goes
Correct.
straight to work shrinking that original core balance.
Exactly. And it drops the balance right then and there. And because next month's interest is calculated on that new smaller balance, your mandatory interest cost drops.
Wow.
And more of your regular monthly payment goes toward the balance. So you are essentially creating a positive snowball effect.
You're using the math to your own advantage.
That's right.
By making extra payments on the core balance, you're effectively jumping ahead on your loan schedule. Every extra dollar you send chops the time clean off the back end of your loan contract. You're using today's small savings to buy back your future timeline.
And I want to say here too that most banks or financial institutions, mortgage companies, whatever, will not charge you a fee to make extra payments. So there might be fees if you pay off one bank and refinance with another bank. I'm not going to get in the weeds about that, but most banks will not charge you any kind of fee to make extra payments, which is great.
Yeah.
So let's take a look real quick at a concrete car loan scenario to show you how powerful this really is. So say you have a $27,000 car loan for 5 years at a 7% interest rate, making your regular payment about $400 a month. So if you simply decide to add, I don't know, let's say $50 to that payment each month and apply it to your core principal balance, look at what happens to your timeline.
Exactly. By adding just $50 a month, which is a very manageable shift for most households, you shave nearly 7 months off the back end of that 5-year loan.
Isn't that crazy?
You cross the finish
7
line
months.
and own that car free and clear over half a year early.
For $50, right?
And not to mention it saves you on interest.
That's right. And that keeps hundreds of dollars in your pocket that basically for a year and a half early, that would otherwise gone toward the cost of borrowing that over the extra 7 months. So you've completely optimized the timeline simply by taking an active role in how your payments are applied. I mean, that's a massive win.
Absolutely.
That's a win-win.
Yeah, it really is.
So I think a common scenario that we get sometimes comes up in general finance planning is how do you handle multiple loans at the same time? So let's say someone has an extra couple $100 a month to spare. Is it better to split it or focus it?
So having extra cash to accelerate goals is a fantastic position to be in. The situation, the best route is always to favor focus over splitting your efforts. If you take that $100 and break it up into tiny $25 pieces across multiple places, your process ends up actually being fragmented. But if you take the entire $100 and target one specific loan, you will watch that specific balance drop dramatically faster, giving you a clear financial victory sooner.
Yep. And I completely agree with that. I tend, on my personal side, for me, I tend to take my largest balance first. I want to have that big elephant gone. So by the time I get down to a smaller loan amount, I can pay that off quicker.
Exactly.
So I like to take, for me, that's my personal choice. But if you concentrate your funds, it builds such clear momentum. So whether you focus on the loan with the highest interest rate to maximize your savings, or the loan with the smallest balance or the biggest balance to get that rewarding feeling of crossing a line early, keeping extra payments targeted is the fastest way to shorten your overall timeline.
Exactly. Now, what about the logistics of making sure that extra money goes where it's supposed to? We often hear from customers who want to ensure their extra payments are processed accurately on the account end.
Yeah, and it's a great detail to point out, Daniel. So when you make an extra payment online or drop off a check at the branch, you want to make sure it's clearly marked, or you tell someone it's an extra payment toward that baseline balance, or as we mentioned earlier, principal only. So most mobile and online banking platforms have a simple drop-down menu or a clear checkbox for this. But if you are mailing a physical check, which sometimes
Mm-hmm.
we even get,
Yeah.
for loans, just write apply to principal only clearly on that memo line, or put us a note in that
Yeah.
envelope. And then make sure that you check your next statement to verify that your core balance, that principal balance, dropped by that exact amount. It's just a good habit to verify your numbers.
Absolutely. Always verify.
And we can check it, right? We can fix it.
Oh, 100%.
If
100%.
something goes wrong, we can fix it.
Yes. So, this has been a lot of information, but I feel like
Yeah.
it's been a lot of good information. It's been very empowering to look at how we can master our loan timelines. A lot of people feel like they're under the thumb of the bank or their financial
Mhm.
institution, that weight is so heavy on them. But to realize that you can actually take control of that situation, it really is in your hands. I think it's very empowering. So
I agree.
let's give our listeners a simple, concrete exercise to try this week.
There it is. Your actionable tip for this week is the $25 challenge. Use a calculator to see how $25 extra monthly shortens your loan.
Sometime over the next few days, log into your account or grab your latest loan statement, find your current balance, your interest rate, and how many months you have left on that specific loan. Then head online and plug those numbers into a free loan payoff calculator.
And so once your current baseline is set, then run a second scenario where you add just the $25 a month, as we talked about, as an extra payment directly on that core balance. Look at the data in black and white. I'm visual, so I love seeing stuff like that. So see exactly how many months that you can just shave off the back end of your loan and how much money stays in your wallet by doing a small $25 payment that accelerates your timeline into the ultimate inspiration to start building your financial freedom today.
Mm-hmm.
So, Daniel, looking at borrowing through the lens of time takes all the stress out of that conversation. It changes debt from a permanent burden into really a manageable timeline that you have the power to control.
Absolutely. It really does. And when you realize that every extra payment is just investing in your own future calendar, budgeting becomes incredibly satisfying. You're using your local banking tools to actively build a faster path to your goals.
I mean, you couldn't have said it any better. So, next week, we're going to look ahead a little bit. We're going to shift our focus to really a critical protection topic for your families, and it's identity theft and protecting your children.
This is absolutely huge. It's a huge silent issue that many parents don't even think about. Minors don't actively check or use credit, and they can be prime targets for silent identity theft. And errors can go unnoticed for years. We're going to talk about how to protect your child's future credit baseline using simple, preventative steps like a minor credit freeze.
I mean, it's really going to be an essential conversation for any parent, guardian, grandparent out there. So you make sure to our listeners to hit that subscribe button on your favorite podcast platform so when the episode lands in your feed next Tuesday morning.
Thanks for spending time with us today and for taking these proactive steps to truly make sense of your sense. We'll see you next week.